Good morning, Noble Gold. Happy Friday and happy December. We haven't had a live for almost a couple weeks. Took a break for Thanksgiving. Hope everybody had an enjoyable holiday. And of course, now we're getting ready for Christmas and the holiday season. So today we've got some exciting stuff to cover. We're not just doing charts, we've actually got some bigger stuff to unpack. Banks backing away from physical silver, billionaires quietly positioning themselves in the white metal, the CME's 11-hour shutdown from last week, which caused a stir in markets, and a new way of looking at the geopolitics between the US and China being metals centric and the precious metals war between the two countries that may be unfolding. So, this isn't just finance, we're talking power and security. And today we'll just jump right in. What we know is that silver is having a systemic fallout and the banks are stepping away from their traditional roles as suppliers. Silver inventories are shrinking rapidly, not because silver is being used, but because it's disappearing from reported vaults. Physical markets are tightening. Sources indicate major producers and institutions are stockpiling this stuff alongside countries. And this is a real squeeze in physical metals, and it's revealing the core truth that paper markets can freeze, but the physical metal itself can't. And that's why here at Noble Gold, we emphasize physical ownership as a physical bullion dealer. We want you to have the real metal in your real possession. So, what are the reasons for the banks retreating from their traditional roles as stores or custodians of the metal on the exchanges? Banks aren't just stepping back because they don't like the metal. They're stepping back because the entire structure of the silver market is changing and the old model is breaking down. Some core reasons that we'll get through, there are five in total. So the first is that actual physical silver supply is extremely tight. So the global silver market has shifted from being a paper heavy or paper driven system with futures, paper contracts, ETFs, and derivatives. And now we're shifting to a world where investors want the real metal in hand. But here's the problem: mining output has been flat to down for the better part of a decade. Industrial demand continues to explode with sectors like solar, new generation EV batteries, other electronics, AI data centers, silver's use in military applications like warheads. You've also got global stockpiles draining. So when inventories fall, banks can't reliably hedge or replace the physical metal that they're selling. And if they sell bars today, they're not going to be able to replace them as easily or as cheaply as they have in the past, which creates problems for them tomorrow. No one wants, especially a bank, no one wants to be the last one holding the bag. Now, the second reason is that they can't source large quantities anymore. Bullion banks have traditionally supplied wholesalers and institutions from LBMA vaults, COMEX inventories, London good delivery bars, and unallocated pooled accounts. But those sources are being drained as well. Between 2024 and 2025, we've seen 37.6 million ounces of silver disappear from reported vaults, and registered COMEX silver actually hit a multi-year low. LBMA silver stockpiles also fell sharply and have been falling sharply, as has been widely reported throughout the course of this year. And banks simply cannot obtain reliable large lots of physical metal anymore. And when a bank can't become a source of physical supply, the safest move for it is to just stop selling it. Now, there's also a lot of regulatory and risk factors at play here. Now that the new Basel III rules have come into effect this year, these regulations push banks to hold safer assets, and they actually punish the holdings of unallocated metals, leveraged metals, and derivatives of metals. And they also don't like the big mismatch between paper and physical supply, like with silver being 375 paper ounces that trade for every one physical ounce. And so physical silver is now capital expensive for banks to hold and to trade. The other risk is that of a short squeeze. So we have seen a huge run on physical metal, and the paper short positions have really become a big risk. Their hedges have stopped working. Short positions have become dangerous. Spreads widen, and volatility in this market has increased. And risk reward no longer favors banks being a major physical silver holder. Now, profits also, banks being profit driven, they are not incentivized at this point and in this type of market to step in. They don't make as much money being a physical bullion supplier as they do trading the traditional things that banks do best, like derivatives, swaps, FX trading, structured products like ETFs and mutual funds, and also the credit markets and credit products and facilities that they provide. So with physical metals, there's operational risk with transportation, storage, insurance, and redemptions, of course. And banks will go where the money is, and there's just too much risk and not a big enough margin in physical silver. Now, fifth and lastly is like sovereign accumulation has actually crowded out the available supply for banks. So countries that have been buying it, as we know, China, Russia, India, Turkey, Morocco, Saudi Arabia, the US now, with silver being considered a strategic commodity, states are able to bypass open market operations, and they can draw metal straight from refineries before it even hits the banking system. And their priority on owning the physical metal has left a lot of shortages in the actual demand and availability for banks to hold this. So it's nice to see the banks finally taking a step back and being unable to control the silver market with their paper products and derivatives. Now we probably come into a phase where we'll see real price discovery in silver. But before I get into this next section, which is huge news as well, we will take a quick break for commercial.
Talking to people today about their retirement accounts. Sir, excuse me.
Yeah.
Do you have a retirement account?
Yeah, I've got a TSP from my old government job.
How's that doing?
I'm forgetting about it. I can't contribute to it. There are fees to get the funds, and the investment options are limited, so the money's just stuck.
How about a gold IRA?
I can do that.
Absolutely. You can roll it into a gold IRA, and you have all the same tax advantages as a TSP, but with more flexibility. And you can put physical gold and silver in your retirement account.
I'm taking control with Noble Gold Investments.
Your retirement, your rules. Noble Gold.
Okay, welcome back. So, what else happened last week? Very big news in the silver space. We have an alleged whale that's now taken a massive position in the silver market. Paul Tudor Jones, an absolute Wall Street legend, personal wealth of about $8 billion and manages hundreds of billions and has for decades on Wall Street. He has now allegedly stepped into the market, and just last week, coinciding with the CME closure, which we'll get into in a minute, he is rumored to have bought 32.2 million ounces of silver on the in futures on the COMEX. On the commodity exchange. So that's 6,440 contracts at 5,000 ounces a piece. An absolutely enormous purchase, enough to move markets. That explains why we've broken out to new all-time highs, the highest monthly close for November, the highest all-time price ever today, and we'll get to that in the charts. But why does it matter? If this rumor is true, or even partially true, it carries massive implications. What it means is mega hedge funds are now seeing the potential that silver has and the price discovery element that will occur now that the paper market is breaking and the price suppression is breaking. We are seeing money flow from traditional assets and even other assets like Bitcoin and gold. They're now flowing into specifically silver, which is a tiny market. Paul Tudor Jones actually quoted in saying specifically that he thinks silver is the best trade in the entire world for the next 10 years. And I think that should carry a lot of weight. So $1.9 billion is not chump change. Okay, and that probably explains again why we had these major moves. What this also says is that we have smart money flowing into this space because of the visibility that there's a structural squeeze and a fundamental shortage. So we have banks as it exiting the silver markets. We have inventories shrinking. We have industrial demand soaring. We have mining output shrinking. We have strained mints for production of actual bullion to be sold to retail products. And now we have billionaires piling into this space. This, my friends, is how secular repricing begins. And I think we are still early in this game. With that being said, lots of happy clients this year, have had a fantastic 2025. I'm looking for an even better 2026. If you've been thinking about your portfolio and want to have some diversification into the metal space, taking a play out of Paul Tudor Jones and other billionaires' playbooks, is stepping in, and you have not yet. If you have questions for me, I am a senior sales associate, been here 5 years, but I have many, many distinguished colleagues as well. We're top salespeople. We're investors ourselves. We walk the walk and talk the talk. So if you'd like to talk to us here at Noble Gold, that's 877-646-5347. And we can get now into the CME meltdown exposing system fragility. And this is all from last Thursday and Friday night during the Thanksgiving holiday. So on November 28th, we witnessed something that should concern every investor. We had a failed cooling system in a private equity owned data center, the CME being the Chicago Mercantile Exchange, where commodities trade. And you see $26 billion of daily trading on the CME. So a simple cooling glitch shut down this market for 11 hours. Now, the conspiracy theorists, like myself, would believe that this was actually an attempt to halt silver from breaking out to new all-time highs. It surged from 55 to $58.50 during this breakdown, and you actually had the spot price of silver go above the price of the futures market in silver, and that's called backwardation. What that implies is that there's a higher price to be paid for physical silver in hand rather than on a price of a contract of silver tomorrow. And backwardation is an extremely bullish phenomenon in any commodity, but in particular in silver at this time. And so the halt and this surge in the price happened at a time where you can only assume that something fishy is going on. Now, this cooling error is the reason that it happened. But what happened during the outage was paper silver stopped trading. Paper gold experienced a violent crash, but physical silver kept trading and selling and being investable all around the world. I, on that particular day, on Friday of last week, sold several $100,000 worth of silver myself. Now, again, that underscoring that paper markets can be controlled and manipulated and suspended. And of course, we know that from what happened to the Hunt brothers in 1980. But the physical bullion market, your local coin shop, a national dealer like Noble Gold, we continued to sell the metal regardless of the volatility and the issues and the crisis that we had on the paper exchanges. So this single event reveals a truth, and it really just tells us how fragile paper markets can be. It could be a cooling issue, a cyber attack. What we know is that physical markets are decentralized. They're untouchable. There's no counterparty risk. You don't have that with ETFs. You don't have that with the CME. There's no clearinghouse. There's no server farm. There's no private equity data center to be worried about. When physical becomes the only reliable pricing mechanism, you must ensure that you have this in your portfolio. Paper becomes a liability. Physical, as always, is an asset. Now, let's take my last topic. I'd like to get into something that's actually from one of my favorite analysts, and I've seen this covered for months. I figure it's worth introducing to our audience here. Now, Vince Lanci, author of the Gold Fix Substack report, worth giving credit to him where credit is due. He has been looking at the gold and silver bull market of the last 2 years through a different lens. It isn't maybe just a rising price, it's actually a battle between two nations. The US and China have been at war for strategic commodities, rare earth metals, as we know, but precious metals are a key part of that. So let's just have a look at what China's accumulation strategically has entailed over the last couple of years. So China has been liberalizing gold ownership amongst its citizens. It itself, as a country, and the Central Bank of China has been buying aggressively for many, many years. China, alongside BRICS nations and BRICS partners, are building physical vault networks all over the world that will allow for cross-border use of gold as collateral instead of instead of holding U.S. dollars in U.S. Treasuries traditionally, which of course is on the decline these last couple of years as well. I noted a couple episodes ago that Treasury ownership is now less on a nominal basis by all foreign countries. It's a lower nominal amount than the amount that's held in gold amongst all the foreign countries in the world. And that trend of not wanting to own dollars and wanting to own more gold will only continue. And again, this is what China and the BRICS nations have been doing. So the reason that this is important, the vaulting networks and being able to use gold as collateral, is that in the new financial system, a new BRICS financial system, China will collateralize other countries' gold holdings rather than their treasuries to provide them with credit facilities for infrastructure, for strategic projects. In the past, you would get a bridge or a mine built in Africa and they would collateralize US treasuries. Well, they're not doing that anymore. They're building this separate financial system that's fundamentally based on physical gold holdings. And that will allow them to have their gold collateralized in order to get credits and yuan to build local infrastructure. Now, Lancey's interpreting current tensions as like a structural rivalry for control over hard assets. It's also a competition between the old system of paper dominance to the new system being based on the strength of physical reserves. And China, of course, has been pushing for the international use and internationalization of yuan-backed gold. Directly challenging the petrodollar and US dollar hegemony. But why does this matter for silver? Silver isn't just an industrial metal, it's now part of this strategic debate. China has restricted exports of several critical minerals, silver being included. And in rising global demand, limited Western inventories and Eastern accumulation point towards a global metals squeeze, of which silver would probably be the primary beneficiary. And so I think the biggest part of all this is the idea that this move away from the dollar, the BRICS nations having a global network of gold vaults where gold and both silver can be collateralized as a tier one asset in order to receive infrastructure loans from China to develop their countries. That is a huge threat to American hegemony and to the petrodollar system. And I think we're still in the early stages of this, but we'll have to keep an eye on it. And in any case, it's extremely bullish for physical metals holders anywhere in the world. With that, we'll take another quick break and then we'll tie it all together, look at some charts, and we'll wrap. So we'll go to commercial. Let's go.
When I first decided to invest in gold, I was a bit nervous and unsure how to start. Luckily, I found Noble Gold Investments. From the very first call, they made investing easy. No pushy sales tactics, no gimmicks, and no confusing free silver offers with hidden fees. Just honest advice tailored to my needs, giving me confidence every step of the way. If you're new to gold investing or want a partner you can trust, visit noblegoldinvestments.com.
Great. So what have we talked about today? Let's just do a quick recap. So we've talked about infrastructure fragility at the CME and the brittleness of paper markets versus the physical asset itself. We've got banks exiting silver sales and not being able to compete in a quickly changing system. We have billionaires accumulating large positions and calling silver one of the most bullish assets in the world for the next 10 years. We have China building strategic reserves and vaulting networks in order to collateralize metals, in order to have most of the world step away from a treasury based or US dollar based petrodollar system. And we, again, just have a very, very strong emphasis on physical ownership of physical metal, and the paper system is failing. We have a strategic shift in these areas, and now we see that the world values precious metals as much as we do. So I want to ask a couple questions here. This would be for the audience to um, post their answers or what their thoughts are below. You can engage with us in the comment section. So if central banks and sovereign countries are accumulating precious metals, what do we imply that that means for fiat currencies? It can't be a good sign. It means that they don't trust the US dollar. It means they don't trust paper-backed currencies altogether. They know that there's a monetary reset likely to occur, although probably only after a recession or a stock market crash, some form of financial crisis that'll allow an opportunity to reset the financial system to one that's backed by physical gold, or at least treats physical assets as a primary. Another question is, if paper futures can freeze, and if future paper markets can be frozen, but physical can keep trading, should we trust the paper pricing mechanisms? Right? When people call me and say this is what the price is online, well, that's more or less the paper price of gold or silver. The physical metal does cost a little bit more than that. And of course, with dwindling inventories and as much demand as we've seen, you are seeing some increasing premiums, but the physical cost of actual metal is not necessarily reflected by the paper price. What do you think? And lastly, do we put any weight and really believe that this is a metals war between two of the world's biggest economies, or is this just a simple market rally? Okay, your thoughts below. And what we'll finish with today are some charts to pinpoint where we're at in the markets. And then we'll close with that. So let's pick up the silver chart. We'll just talk silver today. This is a short-term look at new all-time highs. We made them last week at the end of November, the highest monthly close of all time. We did have a small dip yesterday, but that's been recovered today. So we're actually pushing pretty close to a new all-time high. We could see something like $60 relatively quickly. Of course, 60, now that there's no historical price resistance above our heads, we're in what's called blue sky territory. 60, just as a natural round number, could act as an area where the price gets rejected, and maybe it has to spend some more time here in the mid to high 50s, but it's really all not that far away. And so in the short term, we'll see how 60 presents itself as resistance. Let's take a bit of a zoomed out view so that we can have this next chart that just shows that we've broken way out of the previous all-time high of $50. We've got the 1980 high at 50, the 2011 high at 50 again. And then we have spent more than the last 6 weeks consolidating north of the $50 range. This is different. This isn't a touch and retreat type of move like we've seen in the past. We have a 45-year cup and handle breakout. We should respect and be somewhat humbled by the fact that this is really turning out to be one of the longest but most bullish charts that's only just recently broken out. The implications of where this could go are huge, which of course brings me to my next chart. Having a look at this, which I've shared many times, the weight of evidence, and of course there's a couple of paths to get there. Although the more and more I talk about this chart, the more and more it seems that we are on that first green path rather than the secondary red path, where we spend more time consolidating below 50. We have broken out strongly above that range. We've broken out even above the 55 to 70, 55 to 57 range. Now, can we retest 50? Of course. Can we get to 60 and retest 55? Of course. But this suggests that we are now probably in an accelerated and advancing phase for this major 45-year cup and handle formation. And the weight of evidence puts us somewhere in that, $300 to $500 range, probably over the next five years. So let's take that to the bank, but take it a day at a time. And I thank you very much for taking the time to go through these with me. Now, in closing, this stuff isn't just noise. I hope it's a wake-up call. Billionaires activating and coming into this space. Um, Paper market freezes. Be prepared for a world where the foundation of value isn't paper or marginal price moves. It's physical metals in hand or in a vault of your own. Segregated accounts are what we do for IRAs, and only that, meaning your metals are stored in your account only. You can go there, you can touch them, you can see them. We're the only company that takes audited photographs of your physical metals holdings within your IRA and sends them to you the day that we fulfill your order. And of course, we do tens of millions every month in home deliveries to people around the country, safely to your door, fully insured and securely delivered. Now, if you'd like to talk to me or talk to any of my colleagues, you can reach me at 877-646-5347. And again, it's Micah from Noble Gold with you for another Noble Gold live stream. I thank you very much, and we'll see you next time. Take care, guys.